Financial crises are terrifying times. Families lose jobs, homes, and their life savings. Stock markets tumble. Governments scramble to stop the bleeding. For most people, it feels like the end of the world. But for a select group, professional investors, these moments of chaos are something else entirely. They're opportunities, big ones. While others see doom, the pros see opportunities. It might sound callous, but let's unpack this. First, what exactly is a financial crisis? At its core, a financial crisis happens when confidence in markets collapses. Banks fail, investments plummet, and economies grind to a halt. Think of the 2008 global financial meltdown, when toxic mortgage debt nearly brought down the entire system. Or the COVID-19 pandemic, when markets free fell in March 2020 before rebounding to astonishing highs. What makes professional investors different isn't just that they survive these storms. It's that they often come out of them richer and more powerful than before. But how do they do it? Let's pull back the curtain on their playbook. First, let's start with the most provocative strategy on the list, short selling. Ever hear the saying, buy low, sell high? Well, short sellers flip that on its head. They aim to sell high first and then buy low later. No, they don't have magical powers. It's all about borrowing and timing. Here's how it works. An investor borrows shares of a stock they believe is overpriced. They sell those borrowed shares at today's price, hoping the stock goes down. If it does, they buy the shares back at the lower price, return them to the lender, and pocket the difference. Now, this strategy is risky. If the stock price rises instead of falling, the losses can be unlimited. But during a financial crisis, short sellers thrive in the chaos. They bet against failing companies, over-leveraged banks, or even entire sectors. Take 2008, for example. Hedge funds that shorted mortgage-backed securities, those bundles of bad loans that caused the crash, made billions while others lost their shirts. Short selling is a bet that the house is about to collapse, and in a crisis, those bets pay off big. Next, let's talk about hunting for bargains. When fear grips the market, asset prices don't just fall, they nosedive. Stocks, real estate, or entire companies can suddenly sell for pennies on the dollar. This is when professional investors strike. Warren Buffett, one of the most famous investors alive, has a famous saying, "Be fearful when others are greedy, and be greedy when others are fearful." During financial crises, fear drives prices to irrational lows, creating what investors call a buying opportunity. Here's an analogy. Imagine a pristine beachfront mansion. Normally, it'd sell for millions, but suddenly there's a hurricane warning. Buyers panic, and the house, untouched by the storm, is now selling for a tiny fraction of its value. That's what happens in financial markets during a crisis. Long-term investors like Buffett look for solid companies, ones with strong fundamentals that have been unfairly beaten down. They scoop them up cheap, secure in the knowledge that calm will eventually return, and with it, the mansion's true value. Now, moving on to a more complex strategy, derivatives. Derivatives such as options and futures might sound like Wall Street jargon, but they're powerful tools in a crisis. One way investors use derivatives during downturns is through something called a put option. A put option gives an investor the right, but not the obligation, to sell an asset at a certain price. If the market tanks, the value of that put skyrockets, working as a cushion or even a profit magnet during a collapse. For example, during COVID-19, some astute investors predicted the sudden market drop in early 2020. Those who had bought put options on major stock indices made enormous returns while everyone else saw their portfolios shrink. Derivatives aren't for the faint of heart or the untrained eye, but in skilled hands, they're like having a parachute when the market free falls. Another favorite play is distressed asset investing. During crises, companies struggle to pay debts or stay afloat. Professional investors, particularly private equity firms or hedge funds specializing in distressed assets, step in like vultures circling a carcass. They scoop up failing companies, bonds, and loans for fractions of their face value. Now, this isn't as heartless as it seems. Sometimes these investors provide capital to salvage a business. Other times they break it up and sell the pieces for parts, often making a sizable profit. Let's not forget about the role of preparation in all of this. Professional investors plan for crises when times are good. They diversify their portfolios, hold cash reserves, or allocate funds to assets like gold or government bonds, things that tend to rise when markets fall. This is like building a fireproof house before lightning strikes. When the flames of a financial crisis spread, they're ready, armed with dry powder, money they can deploy when others are too strapped to move. And here's an interesting twist. Some investors don't just wait for a crisis to profit, they help trigger it. This doesn't mean they're orchestrating global recessions in back rooms, but rather they capitalize on vulnerabilities in the system. Think back to the GameStop saga in 2021. Massive short sellers bet against the struggling retail chain, magnifying the pressure on the company. Though the tables turned on them when retail investors pushed the stock up, it was a rare case where the Davids of Wall Street humbled the Goliaths. Critics argue this type of behavior worsens crises, deepening the pain for everyday people. But professional investors counter with the idea that by betting on failure, they expose weaknesses in the market, bringing about needed corrections sooner rather than later. Now, before you think this is all about squeezing profit from bad times, remember that many professional investors take a long-term view. They know that markets, even after the biggest crashes, inevitably recover. Instead of trying to time every peak and valley, they buy assets with the confidence that values will rise again. Here's a quick historical reminder. During the Great Depression in the 1930s, stocks lost almost 90% of their value. Sounds catastrophic, right? And it was. But those who invested at the bottom made enormous fortunes in the decades afterward. It's the same story today: recession, recovery, panic, patience. The cycle continues. So, what's the takeaway here for you? Let's be real. Most of us aren't hedge fund sharks or seasoned investors, and approaches like short selling or derivatives are likely out of our comfort zone. But there's still something we can learn. The key is preparation, staying calm under pressure, and recognizing that every downturn creates opportunities. Financial crises are moments of fear, and fear is what drives prices to irrational levels. If you can keep a level head, think long-term, and focus on value, you can turn panic into profit, just like the pros. But there's one more thing to remember. While professional investors have teams, resources, and years of expertise at their disposal, their strategies revolve around something anyone can cultivate: discipline. They don't act on impulse. They don't let fear dictate their actions. And most of all, they plan for crises before they happen. Financial crises will come and go. They're a fact of life in our ever-changing world. But the way you choose to respond to them, that could make all the difference in your financial future. The pros see opportunities where others see doom. Maybe next time you will too.